Hi, I'm Susan Brown, and welcome to Bridging the Capital Access Gap. This module gives you some tips and strategies on how to create a quality loan application for your client. So in this module, we're going to cover your role in this large loan application process, which we've already reviewed is a heavy lift for many of the people we hope to serve, and how you can prepare your clients for this process, and how you can help your client present themselves in the best light to a lender. And for more information and resources, please see Module 16. So it's good to talk about your role in this process. And part of that is about a business plan. I taught a business planning course for years when I was working directly with small businesses, and we had a sort of end-to-end business planning course. And here's the kind of things we covered in that class. The product and service description, feasibility, target market analysis, competitive analysis, how to keep your books, how to do a sales strategy and a marketing plan. What I'd like to suggest here is that a business plan for a loan package might have a different focus than the business plan you do in sort of the big picture overarching business course. Because we want to focus on the numbers. Remember, a lender is happy to hear a little bit about the story and the product, but they're really interested in the numbers for the most part. So let's look at what a business plan might look like that's particularly well structured for a loan application. It would focus on sales strategies, history and success, income and expenses, growth strategies, profitability, increased efficiency, new expansion opportunities. These are all things that if you watched the module on good reasons to borrow, these are the kinds of things that you want to focus on in the business plan for a loan package. Not a long story about how the client came to do this business and pages about their product and how excited they are. A lot of the people we work with love to write all of that about their business, and they're very enthused. But we want to sort of contract that part of a business plan and kind of focus on these nuts and bolts, numbers, expansion, what's the project, how much is it going to cost, all those kinds of things in the business plan submitted to a lender. So let me provide you an example that I think is helpful and looks different than a standard business plan. It says now where we want to go, how are we going to get there? And I think that's a really great structure for a loan application business plan. So if you look at this is just an example of a business that outlines where it is now. It's pretending that it has a fiscal year that starts July 1st. And it talks about, look at the factors it focuses on: profitability, cash flow, and sales. Just the thing a lender is interested in. What the status of the business is. And then the next section is where you want to be in a year. And it addresses the same thing. We're going to increase our net profit to 20%. We're going to have no cash shortages. We're going to increase our sales. It's like a game plan for what the next 12 months is. How is it going to happen? What are the strategies to make those numbers aspect of the business happen? We're going to improve profitability. We're going to review our cost structure. We're going to improve our cash flows. And it has an action plan, timing, and who's involved. So you can do this in a page, maybe 2 pages. And I feel like a lender would look at this and go, okay, I exactly know what you're talking about. And I love this sort of reduced, numbers-focused presentation of the business and the project. Now, the other document that's part of this module is just my simple Word document of the same thing. The only change I made is at the very bottom section on how we get there, I added a column that said cost. Because remember in a previous module, I talked about that sources and uses of funds document. Well, here, if you add cost, because you're going for a loan and you're kind of penciling out for the lender what your project is going to cost, and that could dovetail with your sources and uses of funds document and demonstrate that you've really thought through each part of this plan in terms of cost. And if it matches sources and uses of funds, a lender's going to love that and think, okay, these folks have thought this through. Part of your role in helping clients through this is to be their champion, because if you've listened to most or all of the modules in this series, you'll see, wow, there's a lot of work to be done and it can be a bit overwhelming. So if you can be your client's champion and kind of cheerlead them through this process, I think that's a really important role you can play. The other thing I think it's very important to understand is if we're working with folks who generally are left out of systems, haven't had certain entitlements and privileges, and they have personal circumstances that might come up and make it harder for them to complete this, it's great if you can address some of that as well. So you're working with the business and you're working with the person and helping them get through this whole process, dealing with both sides of their lives. So while we're over here being the champion of our clients and taking as personal approach as we can to get them through all the stages of loan application development, we have to keep in mind that on the other side is the nuts and bolts of what a lender is going to likely require, which is that your client has to fit their 5 C's. The lender wants to minimize risk, get repaid, adhere to their institution's policies, answer to shareholders and funders, and focus on the numbers. So it's a kind of, you're the in-between man or woman going in between, this kind of personal development, business development process with your client, and understanding that the lender you work with, depending on how conventional and formal they are, might be holding their applicants to a pretty high standard in terms of the numbers and qualifications. So in this question of what is a quality loan application, you want to focus on the numbers because that's how lenders think. And again, if you know the lenders in your area, you understand some of their criteria, that's going to help you tremendously. And then that helps you prepare your client for this journey. And what I'm going to argue here is in your application, while there are 5 C's of credit, if you focus on 3, which is credit, cash, and collateral, you've taken your client a very long way to qualifying for a loan. As we've said, the lenders in your area are going to have different products, processes, criteria, required documents, and the more you know about that, the more able you will be to help your clients create a quality loan application. And you can strategize with your staff at your organization on how best you can set up services to work clients through the process to get there. So in terms of a quality application, probably the most important C of the 5 C's is credit. So helping your clients address credit issues is, I think, the most important service you can offer. So first you want to have your client pull their credit report. There's information here and in other modules about how to do that. If you can pay for the FICO score, there's places that say they give you a free FICO score. My personal experience has been that doesn't match the one the lenders see. And so you might want to actually either have your client pay for an actual credit score, or if you're working with clients for whom that's a hardship, put it in your budget and pay for their credit score so they can actually see the score the lender sees. Because frankly, the difference between like a 620 credit score and a 650 credit score can be very big and make or break the difference. So you want to know really what the lenders see in terms of FICO score. Once you've pulled the credit report with your client, you want to go through every single item on there and make sure that you understand it and they understand what's there. Especially you want to identify errors, see if there's slow or late pays, collections, public records. These are all things that are kind of derogatory. They're called derogatory types of elements that can be on a credit report. You don't want to just send a client in blind with these kinds of things on their credit report. You want to help them address the problems before they apply, or write up a really good explanation of why those things are there and how they're not going to happen in the future. If it's below 680, you might want to start looking for mission-based lenders in your area. Credit cards and crowdfunding, we go into this more in other modules, other options if the conventional lenders aren't available to your client. Another way you can help clients prepare a quality loan application, in addition to correcting any problems you see on the credit report, is do a brief survey on how leveraged they are, how much debt they currently have. Remember on a previous module, I showed you how you can see what the monthly payment is for every outstanding loan the borrower has. You can add that all up and kind of see how much debt are they carrying right now. You could do a little bit of analysis to say what percentage of their overall income does this debt represent. Now, I don't go into debt to income analysis in this series because some lenders use it, some don't. They all have different measures of debt to income. But with lower income clients, if they have 40% of their income going to debt or more, it starts to look like they're over leveraged. And if that looks like the case to you, you might want to talk to your clients about somehow reducing the existing debt before applying for more, because a lender might see a very highly leveraged situation and just think, ugh, I don't want to go there. The other thing a client might do is pay down some debt before applying for a new loan, especially if there's high credit card balances. If there's a lot of credit cards, or if there's high balances on the credit cards. Overuse of credit cards can look like people are augmenting their personal lifestyle or their personal expenses too much with debt as opposed to paying with cash. And the other thing about credit cards is lenders like to see the balances at half the limit or less. So if you see a lot of maxed out credit cards, that's going to be a red flag. So analyzing the existing debt in terms of how much, how high compared to income is another way you can improve a client's application by getting this down to where a lender feels comfortable before you apply. You may work with clients who go and pull their credit report and there is none, or you pull the credit report and it's almost empty. There's very little on there. And these are credit invisibles or people what they call thin files. Some lenders won't lend to people in this situation or have concerns about lending to people in this situation. First of all, if this happens with a client, you want to identify the reason. Is it because they're very young? Young people sometimes have not had any debt, or they've just never gotten approved anywhere. They've never applied. Maybe their immigration status or their citizenship status has prevented them from stepping into credit, or there's been identity theft. Try to figure out what's going on if there's no credit report or a thin credit report. There are ways that you might be able to help with financial literacy. That could be one of the problems that could help solve this. Maybe your client just hasn't stepped into banking around checking accounts and credit cards and just doesn't really know how to do that. And you can say, well, our first step is to get some of this banking knowledge and relationship going before we talk about a bigger loan. Maybe they need help tracking expenditures, managing credit cards, or understanding how income and pay and savings work. It could just be a financial literacy issue that could be well served with some basic education. Once you've looked at those two things, the other way some people step into debt is with a secured credit card. So they save up $300, go into a bank, say, I'm going to deposit this in some way that the bank approves of, and the bank gives you a card up to $300 of credit that is secured by the savings account. You kind of say, what's the point of that? Well, the point of that is just to start this whole credit, getting it rolling. I mean, that's what's important, is unfortunately, credit is the doorway to a lot of things in our culture around financial well-being. And we've just got to start this credit process somewhere. So a secured credit card might be a great option. Or if there's somebody in that person's life where they can become an authorized user on their credit card, that's another way. As soon as you're an authorized user on someone's credit card, it will start showing up on your own credit report. I would also like to refer you, as I do in many other modules, to Credit Builders Alliance. It's an amazing nonprofit organization that this is their whole area, is credit improvement for low and moderate income people and nonprofits working with those populations. They will have more training and information and details about how to address this problem of credit invisibility or thin credit files. So as I said earlier, what is helpful in pulling together a quality application is to focus mostly on the credit, which we just discussed, and cash. This is the second C that I think is really important. You want to paint a picture in the application of how your client is going to demonstrate cash capacity. So, of course, defining the project costs will determine how much the client needs to qualify for a loan. Then you can amortize the loan, as I've showed you in the previous module, so that you can see what the monthly payment is. And then start to say, how can we demonstrate the ability to make this loan payment? What is the best way we can do it? Do we do it with a P&L? Do we do it with a tax return? Do we do it with bank statements? What's the best case here that we can make that, yeah, my client can afford this loan? You want to identify growth trends and all those new sales and net profit opportunities as best you can. You want to identify any personal sources of repayment, like if a spouse has a pretty well-paying job or there's other types of income or revenue coming in, you want to make sure you make that case so that the lender knows all the sources of cash available to repay the debt. And if you're using projections to demonstrate cash capacity, make sure they're really well researched and annotated and documented. Don't just throw a bunch of numbers into the spreadsheet. Say where the sales numbers came from. Say how those sales numbers are going to be achieved. Identify how you determined what the expenses are and explain the bottom line. So these are some strategies on how to say, here's our best foot forward on demonstrating cash capacity. I just want to say a few things about bank statements because this may be the best financial statement your client has. It may be the place where you're making the best cash capacity argument in your loan application with your client. So let's just review a few things that will make this part strong. It could be that your client has multiple checking accounts. Now, of course, we want to make sure all clients who are running businesses have a business checking account and a personal checking account. We always want to see two. But there have been practices at some of the larger banks where they are selling vulnerable people and vulnerable communities multiple products that they don't need. I worked at a CDFI where an application came in and I think the applicant had 6 or 7 bank accounts. And at first blush, you think, oh, this person doesn't know how to handle money. They've got 7 checking accounts. Until we realized they were sold products that they didn't need because it was part of the sales strategy of the bank and they prey on certain communities to do this kind of sales. So if you happen to see your client with lots of checking accounts, you need to research that and say, why do we have so many checking accounts and can we consolidate and get it down to, mostly you only need one personal and one business and that suffices. You want to look at some history, get 4 to 6 months of statements before you send a client to a lender and look at them and look for certain things that I have listed there at the bottom of this slide. You want to make sure they have proper use, personal and business. Like I worked with a borrower once and she was paying her gym membership out of the business checking. And of course, if you really understand QuickBooks and you make that a owner's draw, it works. But, I just don't recommend it. You really just want business expenses coming out of the business account and personal expenses out of the personal account and not have this kind of commingling of business and personal and you can't quite tell what's going on. It tends to paint a picture that the client doesn't really know how to manage the money properly or maybe know the difference between business and personal. So try to get a few months of clean and proper kind of separation of business and personal. If your client has some not sufficient funds, bounce checks basically, that's a big red flag for lenders. So what you want to do is say, look, we need to figure out why you're bouncing checks. Is it that you aren't noticing that you don't have enough money when you go and write checks or use your debit card? Is it what's going on that's causing this not sufficient funds to show up on your checking account statement and try to fix whatever the behavior or problem is there if you can. And then get 4 to 6 months of really clean bank statements with no not sufficient funds before you apply. A lender wants to see that someone is managing their money, living within their means and not bouncing checks. The other thing about bouncing checks is that they're expensive. They are so expensive. Somebody bounces checks, they're spending hundreds of dollars on fees. And so we don't want our clients spending their precious dollars on bank fees. You can also use your bank statements to do that analysis that I showed you in the last module on debt service coverage to start to get a sense, is there sufficient cash in the business or the business and personal combined to make the new loan payment? So you can do a lot of work on bank statements as part of your quality loan application before you send it in to the lender. The third C I want to focus on in terms of a quality loan application is collateral. Now, most lenders do require collateral. Not all. There could be some mission-based lenders that don't require any collateral, but even most of the CDFIs I've worked with required some form of collateral. Luckily, our mission-based CDFI type lenders are willing to accept something that's relatively low value relative to the loan amount. I worked with Opportunity Fund once and one of their staff told me, yeah, we've got some $70,000 loans in our portfolio backed by a $5,000 car, because they know that the collateral really isn't a way for them to recover all their capital. It's a way to make sure that the client takes repayment seriously, and they were willing to trust the client with that kind of loan to value ratio. They also might just take a general lien on business assets, even if the business assets aren't very high value. But again, nobody wants to lose all their business assets. So a blanket lien on all business assets sometimes can just be enough motivation for people to make their loan payment. So that's kind of how mission-based lenders often think about collateral, more as a motivational psychological thing than an actual, let's make sure we can recover every dollar of loan if we need to, if something goes bad with the loan. Banks and credit unions might require higher value collateral. In other words, if the loan is $50,000, they may want to see collateral worth $40,000 or $50,000. They're going to want to see a closer relationship between the collateral value and the loan amount. They also might want to have collateral that is more substantial, cars, large equipment, real estate, like that blanket lien on assets might not do it for them. So you want to sit down and review your client's assets, see what they own free and clear and what still has debt on it, and do your best. Again, after you've done your research with the lenders in your area, do your best to say, hey, I think we have some collateral here that will be acceptable to the lender based on what I understand about their needs. The last element I want to cover that can help you with developing this quality loan application and help your clients actually qualify for a loan is this idea of a cosigner. I will say I don't know exactly what bank standards are around this, but in the mission-based CDFI world, it is very common for them to take on a cosigner to bolster a deal that they want to do but is weak in some area. So a cosigner is a great way to secure a loan when you otherwise might be denied. And there's a link in this slide to a page on the Accione Opportunity Fund website that talks about what a cosigner is, how it gets used, the pros and cons, and it's a great resource there to see how that can work. And usually a cosigner it can be a friend, it's often family, but it's a conversation to have, especially when you're looking at the other 3 C's and going, this looks a little weak to me. Is there a cosigner in your life that has a strong credit report or maybe has some strong income that is willing to cosign and strengthens the deal and it gets the lender to say yes? So we've given you some ideas on how to pull together different elements that will make a quality loan application that has a better chance of being approved. So let's just review some of the presentation ideas. Of course, as I said, a financially focused business plan that limits the story part of the business and the business owner's background. A statement presenting the credit report that is straight up and straightforward about any issues that are on there and how they're going to be addressed or have they been addressed. Clean financials, whatever your client can provide, if that's P&Ls, if that's tax returns, if that's bank statements, whatever you can provide, follow some of the tips I gave you to make them as clean as possible. Make sure the lender knows about other sources of income. If the spouse has a strong job or there's some other kind of rental income or something that's not showing up obviously anywhere else in the package, make sure you state that clearly to the lender. Identify your collateral options and with the value documented, if you can do a little research. Most lenders are going to ask for identification, some utility bills to show where you live. They're going to ask for some other types of ID. The other big thing you see there in the bubble is helping your clients digitize all this information. The vast majority of loan applications happen online now. Many of the people that we work with don't have means to digitize easily. They're working off their cell phones and they don't have scanners at home. When I worked for the state of California on a grant program, when COVID hit, there were some grants available for businesses. The biggest barrier for people applying for that grant was digitized accurate documents. So here's your role spelled out for you that can make or break, make all the difference really in a successful application to a lender. In the ideal world, the client does as much of this as possible, him or herself. We want this to be their plan, their information that they understand what's being basically presented to the lender, not information that's just in your head. But the reality is clients are going to need help with parts of this. I found that particularly true with projections. I had very few clients when I was working on the ground with small business owners who could do projections by themselves. We really had to sit side by side in front of a computer and work it out together. But you never want to just take over and do it for them, because then they're not going to understand what any of this means. And they won't really be positioned for future growth in capital without understanding the first steps. So you want to determine your organization's orientation on how you help clients with these things, assess the client's capacity to do different parts of the application, where they're going to need help. Consider how much time you have available, theirs and yours. You're going to have some clients that are so maxed out. They have kids at home. They have second jobs. We just have to be realistic about what capacity they have to do some of this work. And then just work as a team over time to pull it together and do your best to make it a joint project that your clients understand as well as possible. So that's the end of our module on pulling together quality applications with your client. And the next module, we discuss some of the differences between startups and existing businesses in this whole loan application process.